going to be going over just the mortgage industry, what we're seeing, how it affects the real estate market, and just answering some of the questions on what's going on with these rates and with the real estate market. So, Peter, thank you for joining us today, and can't wait to hear what you have to say. I know a lot has been going on over the past few weeks. So looking forward to hearing this update.
Yeah, it's been a little while since we last spoke, Katherine, and a lot has gone on. So kind of do a quick recap. Going back, we saw the failure of a bank. The bank, Silicon Valley Bank, the bank nobody heard of until everybody heard of it, right?
Right.
So that was an indication of all of these Fed moves, tightening the market, tightening liquidity, putting banks in a tough spot, and we saw the failure of Silicon Valley Bank. And on that news, so it's not just economic activity that impacts interest rates, but it's also the bigger picture, global things occur that will impact interest rates. But also something like this, which kind of puts a scare into the marketplace, and a lot of money moves out of stocks and into bonds because bonds are a safer place than a stock would be. And so on that bad news, we saw interest rates improve because more money flooded into the bond market. And then that scare kind of went away. And then we saw as the money left, bonds kind of lost value and interest rates went back up again. So in the past, I'd say month and a half, 2 months, we've seen a little bit more volatility than we had prior to that. So let's kind of get into it. The bottom line, as we've been talking about now for quite some time with interest rates, is inflation. And sorry about the overexposure. I'm next to the window and it's a nice sunny day today. As inflation comes down, interest rates will follow. They will also come down. And on April 7th, we got a jobs report, and it was sort of a mixed bag because the overall unemployment rate came down, and job creation was right within expectations. But when you dug deeper into those numbers, what we saw was that companies were reducing weekly hours on an average basis. And the number was really only by 1/10 of an hour, which seems very minimal, right? But when you extrapolate that over, 1.6 million, I don't know the exact number, but just jobs nationwide, that reduction in time equivalates to about a 486,000 person reduction in the job force. So what I think was going on here is that companies see they need to cut costs, they need to cut their labor costs, but they don't want to lose their talent. So they say, hey, just hold on. You got to go on a little bit of a shorter time. You're going to make a little bit of less money, but we want to hold on to you. And so that mixed bag in the jobs report showed a little bit of sign of weakening, which we hadn't seen in jobs for quite some time. The overall picture in that also is that most of the job gains are coming in the leisure and hospitality industry, which is actually getting back to pre-COVID numbers. So we're not going to see, much more job gain in that arena. So you take this mixed bag in jobs. You take on April 13th, the producer price index came out, which is an indicator of inflation, showing numbers come down, and we're seeing the overall inflation numbers come down because wage inflation, which was also a problem feeding into overall inflation, and that reduction in hours kind of brought that number back down again. So the takeaway is that inflation is coming down, and the Fed is doing their job by raising rates. But now we're at a tipping point, and the Fed is talking about another rate increase next month, which to many analysts seems very inaccurate, very wrong to do. The analogy that I heard yesterday was you need to lose weight. You're going to go on a diet starting next week. But this week, you're going to eat like a horse and just go crazy. It just seems counter to the overall goal of where you want to go. Why would you want to make things a little bit worse when the numbers in inflation now seem like they're getting better? Why do you want to mess with that? Why do you want to put more pressure on banks by another rate hike? Why do you want to do these things which take time to impact the marketplace? We've already gotten there. Just pause. Let's see where we are. But the Fed is kind of overreacting here.
So is that a guarantee that they're expecting to raise the rates in a month, or is something that they're just still discussing? Because it really does sound it seems like it would be counterproductive than something that would be productive in our market right now. And they haven't really given anything to a chance to really settle in to see how it's going to affect it and if it's going to work before they just jump to another rate increase.
Right. Yeah. There's a 70%, so it's not guaranteed, but analysts are saying, giving it a 70% positivity that it's going to happen.
Okay.
They're usually right. They usually are right. We're below 3%. Their target is to get to 2%. We're very close to that. So again, back to what we were just discussing, you're on the right track. Why another rate hike? It just doesn't seem to make sense. But we'll see. We'll see what happens.
I guess the biggest takeaway from that, though, is that we are so close to meeting the goal of the 2%. And, based on other reports that have been published by the National Association of Realtors, once we get there, then we should start seeing the rates come back down. And so for anyone who is purchasing right now during the height of the spring market, I guess keeping in mind the date the rate, marry the house, which is what we've been saying, right? You said that to me a year ago, and it's coming up to a year ago, June of last year. And, it seems like that will be realistic to refinance and everyone to be able to refinance that has purchased over the past several months, maybe coming up mid to end of this summer, hopefully.
Yeah, or possibly sooner. Circle May 10th on your calendar, because that's when we're going to get inflation figures again. And so they take these inflation figures over a block of time, and the high inflation figures are going to be falling off this calculation, and these newer lower inflation numbers are going to start, as we move the calendar year this way, are going to show significant improvements. And so this is all boding very well for interest rates. The other thing that I also, which buy the house, date the rate, comes into play is the Fed hikes and how it's impacting builders. Now, in the Brunswick County area, we're seeing massive development. So please understand that these numbers are they're national figures, but these Fed hikes have impacted builders and slowing down their ability to produce and complete more homes. And we need that inventory. Inventory has been a problem for a long time now.
Years.
And for those that think that we're in this, because it's still getting misreported in the media. So for those that think that we're in this housing bubble or approaching this housing bubble, it couldn't be further from the truth. There's a shortage of housing, and that shortage is going to keep home prices up. It's going to keep appreciating in a positive, direct. Well, that's appreciation is positive, so it's going to keep going in that direction. And then let's see here. There we go. And so, can you see the graph here?
No.
Oh no. Okay. Now you should.
Now there we go.
There it is. Okay, so as these are bond prices, and red are negative days and green are positive days. And this is going back to February 6th to date. So we saw bonds going down, down, down. When bonds go down, interest rates go up. And then right around here is when that whole banking scare kind of came into play. And you see these longer, including these what I call wicks. These are just intraday volatility on where it closed and how high it went. And that's a big move. And we've seen like a lot of these long candles, but rates kind of improved. And then, now we're seeing that scare went away and bonds are going down again and rates have kind of ticked up again. But here again, guys, we peaked at 7.5%, 7.25% on the 30-year fixed rate, but we're still around 6.5 right now. So overall, you don't see the chart earlier. Overall, we're doing pretty good. We expect this to continue, bonds to continue to go up as inflation comes down, and we will see improvements. So that's
All good news.
it's all good news. It's all good news.
That's awesome. All right. Well, so everybody, thank you for joining in and watching this update. If you have any questions, Peter Martino is available. His contact information is listed below this video, as well as our information, the Cheap Team. If you have questions about your home values, it's selling in this market currently and buying in this market. We are always here to help. Peter, thank you again. Really appreciate the wealth of knowledge that you are always willing to share, and look forward to working with you over the next few months as these interest rates will eventually come back down.
Absolutely. Thanks, Catherine. Have a great day.
Thank you.